Hey everyone, welcome back to the channel. In today's video, I want to talk about my 2.5 crore investment portfolio and the set of rules I have decided to follow going forward. So, this is my performance so far. The green one is the portfolios, and this one is Nifty 50. Its current value is 2.5 crores. So the rules are not just random rules I picked up from someone else. They are principles I have built over years of thinking, reading, observing, and experiencing what truly works in the long run. I have spent countless hours watching investors like Manish Pabra, Terry Smith, Charlie Munger, reading books such as 100 Baggers, The Coffee Can Portfolio by Saurabh Mukherjee, and The Joys of Compounding, and learning from Warren Buffett's timeless wisdom. But I haven't just copied what they do. I have absorbed their lessons, filtered them through my own temperament, wiring, and comfort level, and then shaped them into a set of rules that fit me. These principles reflect both what I admire in great investors and what aligns with my own awareness and decision making style. They are not perfect, no rule ever is, but they are mine. They help me stay consistent, grounded, and rational through different market conditions. And the idea is simple. I want to grow this portfolio steadily over decades, not by chasing the next hot stock, but by owning great businesses and making fewer mistakes over time. Also, I want to say this upfront. I'm not an expert. I will make mistakes. But the goal is to make fewer mistakes, to learn from each of those mistakes, and to document this entire journey openly here on this YouTube channel. So we grow together both in knowledge and wealth. So let's start. Rule number one. Is the business easy to understand? If I cannot explain what a company does in one or two sentences, I probably should not invest in it. For example, Asian Paints, Titan, sells watches and jewelry. It is very clear what they do and how they make money. But something like a company doing AI based cloud migration consulting, if I cannot visualize how they earn, it's not for me. Because when the business is simple, I hold it confidently during tough times. And tough times will come for sure. That is when it truly helps to be invested in quality businesses. When it is too complex, I start to doubt myself the moment stock prices fall. So I want simple, understandable businesses. That is where compounding feels easy and stress free. Rule number two. Do I see or use this company's product or service in everyday life? If I or people around me use the product daily, that tells me the business has a real place in society. For example, I see people using HDFC bank accounts, wearing Titan watches, eating Nestle products, or using Asian paints at home. That is a signal. It's part of everyday life, and that is powerful. These kinds of businesses have enduring demand. Even when the economy slows down, people still use these products. So I try to prefer businesses that are visible and relevant in daily life. Rule number three. Can this business survive another decade or two? This is about durability. If I wake up 10 or 20 years later, will this company still exist and still be relevant? Example, HDFC Bank, Nestle, Titan. I think so. They will exist, most likely. But a small fancy tech startup, maybe not. I'm not looking for fads or one time booms. I'm looking for durable compounding machines because real wealth in the stock market comes not from buying and selling but from holding great businesses for long periods. Rule number 4. 3-year average return on capital employed greater than 15%. Now this might sound technical, so I want to explain it simply. ROCE means return on capital employed. Imagine a business like a person running a shop. If that shopkeeper invests 100 rupees into his business and after a year he earns 20 rupees profit, his return on capital is 20%. I think that is a great business. But if he earns just 5 rupees on that 100 rupees, that's only 5%. less than a fixed deposit would give you. So I only want businesses that are efficient with their money, those that can make 15 rupees or more for every 100 rupees they use consistently. That's what ROCE above 15% means. It shows strong economics and capable management. Rule number 5, sales growth 10-year average greater than 10%. A company that doesn't grow eventually stagnates. So I look for companies that have grown their sales by at least 10% per year on average for the last decade. That tells me people are still buying more of their products year after year. It's like having a shop where footfall keeps increasing every year. ROCE tells me it is profitable, and sales growth tells me that it is growing. When both are strong, it's usually a wonderful business. Rule number 6, don't overpay. Even the best business can become a bad investment if you pay too high a price for it. So I always try to buy below its fair value, which I think 5-year average PE ratio, provided fundamentals are still good. Let me be honest, this 5-year average PE ratio might not necessarily be the best or the only way to buy a business. Some investors are comfortable buying at all time highs because they believe in the long term growth story and don't worry about the short term price swings. And that's perfectly fine, it works for them. It's just that I am not wired that way. I personally feel calmer when I buy a business at a reasonable or slightly lower valuation. It helps me stay invested peacefully when markets get volatile. So it's not about being right or wrong. It's about knowing yourself and investing in a way that lets you stay consistent for decades. In simple words, I wait for good businesses to go on temporary sale. Patience here gives you both safety and better return. Rule number 7, maximum position size when buying is 10%. No single stock should be more than 10% of my portfolio when I buy it. Even if it's a company I love the most, I do not want to go all in because things can go wrong anytime. Regulations, management mistakes, or black swan events. Diversification protects me from one bad surprise. Rule number 8, number of stocks 10 to 20. Number of stocks I own. For me, the sweet spot is between 10 and 20 stocks. Less than 10, maybe it becomes too concentrated for me. More than 20, it gets hard to track and manage. Right now, I have around 24. I will gradually trim it down to fit this range. This is where opinions differ. For someone like Charlie Munger, 3 or 4 businesses might be enough. For a fund manager, it could be 50. But for me, with the level of effort and understanding I have, I know I can't own just 3 or 4 companies. I don't have that kind of deep knowledge or conviction, and honestly, very few people do. What I do have is awareness of my temperament. I prefer to own companies I understand, that I see around me in daily life. That gives me the confidence to hold them through ups and downs. So for now, 10 to 20 stocks feels like the right balance. Enough focus to matter, enough diversification to sleep well. In the future, this number could change. If I start studying deeply and go all in on stock picking, it might drop to 5. That's like the rare case scenario. If I take a more hands off, numbers based approach, it will stay around 10 to 20. And if I lose conviction or stop following the market altogether, I will simply switch to index funds for broad diversification. So, in simple words, my number depends on my effort and confidence. The more I study, the fewer stocks I need. The less I study, the more I diversify. Rule number 9, trim beyond 20 to 30% position. If one stock grows too big, more than 20 or 30% of the entire portfolio, I'll trim a bit. Not because I don't like it, but because I want to control risk. I don't want a company to decide my financial future. For example, if for example I am holding DMart right now, it may be around 7%. If it goes to around 20% and it's firing on all cylinders, like return on capital good, sales, and I feel confident, I let it run to 30%. And after that, doesn't matter even if it's firing on all cylinders, I will start trimming. If it goes to 31%, I'll get it back to 30%. Rule number 10, never sell when return on capital employed is greater than 15% and also sales is greater than 10%. Don't cut the flowers. If a company continues to grow and stays efficient, I simply don't want to sell. Even if the price goes sideways or temporarily falls, or even if it is overvalued, like I'm not an expert in understanding the valuations. So I'll simply be with the quality company. I'll not try to be smart. I'll try to stay with the business. That's how compounding works. The longer you hold a great business, the less you need to do. Rule number 11, never hold when ROCE is less than 15 and also sales is less than 10%. Don't water the weeds. When the company is both not profitable and also growth has stalled and is below my threshold, it is time to sell because the story might be changing. Maybe competition increased or management lost focus. In such cases, I gradually exit and replace it with a stronger business. Rule number 12, no more than 1 to 2 portfolio changes per year. This rule is to avoid churn. I don't want to be consistently buying and selling. Every transaction adds emotions, greed, fear, regret, and taxes. And more than the taxes, it is getting out of a wonderful business, which could be a multi bagger, once in a lifetime opportunity. So, by limiting myself to just 1 or 2 changes a year, I ensure I think carefully before acting. It forces patience and long term thinking. And if something genuinely breaks, like a fraud or major decline in fundamentals, of course, I will act. But otherwise, I will let the time and compounding do the heavy lifting for me. So, my man Charlie Munger, he said, the big money is not in buying or selling, but in the waiting for that right pitch. And when you have wonderful business in your portfolio, just holding it and doing nothing is the most important skill, I think, from whatever I hear from great minds. Yeah. Final thoughts. These are the 12 rules I'll follow for my 2.5 crore portfolio. They are simple but not easy. They demand patience, discipline, and clarity. I'm not chasing perfection. These rules will evolve, and that's okay. Having rules, even imperfect ones, is better than having none. Rules create structure. Structure builds discipline, and discipline lets compounding work over time. The framework is not rigid, it's a foundation for lifelong learning. I'll make mistakes, but the goal is to make fewer each year. I'll share my updates, learnings, and portfolio changes transparently. If you believe in calm, long term investing over constant trading, please follow along. Let's grow together in wealth, mindset, and patience. Thank you for watching, and I will see you in the next one.